And we have linked to the CBO Outlook. The update is available on our website, cspan.org. And now to that news conference with Doug Elmendorf, the Congressional Budget Office, as you heard, projecting a $1.1 trillion U.S. budget deficit for this year, the fourth year in a row. The deficit is over $1 trillion. The briefing from earlier today is about 45 minutes.
Good morning. Thank you all for coming. I'm Doug Elmendorf, the Director of the Congressional Budget Office. This morning, CBO released its summer update to the Budget and Economic Outlook. I'd like to briefly summarize the report, and then my colleagues and I will be happy to answer your questions. We estimate that the federal government's budget deficit this year will be $1.1 trillion, which equals 7.3% of the country's economic output, or GDP, down from about 10% in 2009. This is the fourth year in a row in which the deficit has exceeded $1 trillion. Federal debt held by the public will reach 73% of GDP by the end of this fiscal year, the highest level since 1950, and about twice the share that it measured at the end of 2007 before the financial crisis and recession. As always, we have prepared baseline projections that reflect the assumption that current laws generally remain unchanged. Those projections are designed to serve as a benchmark for lawmakers to use in considering changes in laws. However, substantial changes to tax and spending policies are scheduled to take effect at the end of this year under current law. And whether lawmakers allow those changes to unfold or alter them will play a crucial role in determining the path of the federal budget and the economy. Therefore, we have also prepared projections under an alternative fiscal scenario, which embodies the assumption that many policies that have recently been in effect will be continued. I'll talk about the baseline first and then turn to the alternative scenario. Among the policy changes due to occur in January under current law, the ones with the largest impact on the budget are, first, the reductions in tax rates and other forms of tax relief originally enacted since 2001 are set to expire. Provisions that limit the reach of the alternative minimum tax, or AMT, already expired at the end of last year. A second, sharp reductions in Medicare's payment rates for physician services are scheduled to take effect. Third, automatic enforcement procedures specified by the Budget Control Act of last year to restrain spending are set to go into effect. And fourth, extensions of emergency unemployment benefits and a reduction in the payroll tax for Social Security are scheduled to expire. If allowed to occur, those sharp reductions in taxes and sharp reductions in federal spending, and increases in taxes will lead to a dramatic reduction in the federal deficit, trimming it by almost $500 billion next year. That would be a significant tightening of fiscal policy and would probably lead to a recession early next year. Specifically, our baseline economic forecast shows continued modest growth in the economy during the rest of 2012, but a drop in output during the first half of next year at an annual rate of nearly 3%. Following that drop, we anticipate that output will expand again in the second half of next year and beyond. However, the unemployment rate will rise to about 9% in the second half of next year and remain above 8% through 2014 in our forecast under current law. Those tax increases and spending reductions will also lead to relatively small deficits throughout the coming decade and a declining path of debt relative to GDP. Our baseline budget projections, which assume, as I said, that current laws regarding taxes and spending generally remain unchanged, show deficits close to 1% of GDP in 2015 and later. With small deficits and a growing economy, debt held by the public falls from 73% of GDP in 2012 to 58% of GDP in 2022. That's what we think will happen under the baseline. To illustrate the consequences of possible changes to current law, CBO has also produced projections under an alternative fiscal scenario that incorporates the following assumptions. First, all expiring tax provisions, except the current payroll tax reduction, are extended indefinitely. Second, The AMT is indexed for inflation after 2011. Third, Medicare's payment rates for physician services are held constant at their current level. And fourth, the automatic spending reductions required by the Budget Control Act, which are set to take effect in January, do not occur, although the law's original caps on discretionary appropriations are assumed to remain in place. That set of alternative policies, which are similar to those that had been in effect in recent years, would lead to budgetary and economic outcomes that would differ significantly, both in the near term and in later years, from those in our baseline. For 2013, the deficit would again exceed $1 trillion. Deficits would remain very large throughout the coming decade, averaging about $1 trillion a year, or 5% of GDP. Revenues would be about 18% of GDP, quite close to their average during the past 40 years. But federal spending would be much higher, about 23% of GDP, above its 40-year average of 21%. That increase in outlays, compared with the historical experience, reflects much higher outlays relative to GDP for Social Security and the major health care programs. That is partly offset by much lower outlays relative to GDP for all other federal benefits and services taken together. With such large deficits, debt held by the public would climb to 90% of GDP by 2022, higher than at any time since shortly after World War II. With that budget path, the economy would be stronger in 2013 and 2014. Economic growth would be modest, but we would not anticipate a recession. Instead, real GDP would continue to expand, and the unemployment rate would move slowly down rather than up. However, rapidly escalating federal debt would increase the risk of a fiscal crisis, during which investors would lose confidence in the government's ability to manage its budget, and the government would thereby lose its ability to borrow at affordable rates. Rising debt would also hinder national saving and investment later in the decade, reducing GDP and income relative to what would occur with smaller deficits. The policies assumed in the alternative fiscal scenario would put us on a path of federal debt that would ultimately be unsustainable. Therefore, as we have noted many times before, the key issue facing policymakers is not whether to reduce budget deficits relative to those that would occur under current policies. The question is when, the question is how. If lawmakers do not reduce the deficit sharply in 2013, perhaps because of the near-term economic consequences, they will need to reduce it later. At some point, we will need to adopt policies that require people to pay significantly more in taxes, accept substantially less in government benefits and services, or both. In closing, I want to acknowledge the more than 120 people at CBO who were directly involved in the production of this report, and the many others who offered critical support. In addition, the staff of the Joint Committee on Taxation provided valuable assistance. I want to express my appreciation to all those people for their talents and their dedication. Thank you. My colleagues and I are happy to answer your questions.
Damian Paletta with the Wall Street Journal. Can you, even if the fiscal cliff is avoided, the 1.7% growth for next year is still really weak? Why is that? Why isn't the economy picking up?
The evidence suggests that following financial crises, economies tend to have more severe slumps and more gradual recoveries than is the case following recessions, in the case for recessions that don't follow from financial crises. In the United States today, we think that the demand for goods and services is being held back by a number of factors. One is the overbuilding of our housing stock leading up to the financial crisis. There are a large number of unoccupied houses today, quite a bit fewer than there were a few years ago because housing construction has been so weak, but many more than would normally be the case. And households with good credit histories are able to borrow for mortgages at low rates, but households with weaker credit histories have much more trouble getting mortgage money. So there is much weaker demand for housing construction than there is normally coming out of recession in the United States. Another factor holding down economic growth has been restraint in spending and hiring by state and local governments. Normally, hiring proceeds by those governments and is a factor boosting economies after recessions. That has not been the case this time. There's been a tremendous loss of households' wealth in the stock market and in the value of the homes that people own. Despite these various factors, of course, we and others have not been able to perfectly predict the nature of this recovery. There have been a number of developments that I think outside this country that have mattered as well. Obviously, the situation in Europe is of a great deal of concern. It's one of the risks to our economic forecast that we highlight, and their problems have been a drag on this economy and have the potential to be a much larger drag. So we don't entirely understand what is going on in the economy. I wouldn't claim otherwise. We are in the process of producing a report on the slow recovery, work that has come out of our forecasting work, report in which we're trying to assess and explain to people what we do see going on, and we hope to have that report out shortly.
Alan Fram with AP, your projections for the consequences of going over the fiscal cliff seem to have gotten a little worse than they were earlier this year. Why is that?
Well, relative to the report that we released in May about the effects of this fiscal restraint on the economy, we have lowered our projection of economic growth for next year. That is primarily due to a reassessment by us of the underlying strength of the economy. The economy has been growing at a modest pace for the past 3 years. We expect that to continue, but we have pushed down a little bit how strong we think growth would be in the absence of fiscal tightening. And in an economy which is growing at such a modest pace, fairly small shocks can matter and large shocks can matter a tremendous amount. And I think what we see coming for next year under current law is a very large amount of fiscal tightening, a larger reduction in the deficit relative to GDP than we've seen in any year since 1969. And that is a sufficiently large shock, negative shock, to the demand for goods and services next year to push the economy into a significant recession, in our judgment. Yes?
Patrick Rice with Politico. You mentioned the threat of that we'd lose our ability to borrow cheaply. We're pretty deep in debt. Bond rates are lower than ever. When is this sort of magic tipping point coming where all of a sudden these bond rates are going to spike? I feel like we've been warned about them for a long time, and now debt's past the point where a lot of people said this would happen, and yet bond rates continue to fall.
Well, interest rates on Treasury securities depend on a number of factors. One is certainly the amount of Treasury debt in the financial system, but other factors are very important as well. And we think that rates on Treasury securities are especially low right now, despite the high level of Treasury debt, for a few reasons. One is the weakness of the U.S. economy and the preference by many investors to hold safe assets. So the rates on Treasury securities are especially low because they are viewed as safer than many other alternatives in the U.S. financial system. A second factor keeping down U.S. Treasury rates is the views of investors about our assets relative to assets in other countries. The serious banking and fiscal problems in Europe have led investors to, who are seeking greater safety, to move assets out of European financial markets and into ours, and again into the safest asset in our financial markets, which are still generally viewed as being Treasury securities. So between the situation in the U.S. economy and the situation in foreign economies, I think it is not too surprising that rates are low, although we didn't predict precisely the current mark. In our projection, rates on Treasury securities increase gradually. They don't rise very much at all for a little while, and that's in our projection because we have this recession coming next year in response to the fiscal tightening, and we expect that under those conditions, the Federal Reserve would undertake a further action to stimulate the economy, and that would hold down short-term rates for longer, and that would hold down longer-term rates to some extent as well. So we have interest rates rising later in the decade. By the end of the decade, the rate on 10-year Treasury notes in our projection is back up to 5%, which is closer to a more typical level. Now, you used the word a spike in interest rates. It's certainly possible for rates on our debt to spike upward at some point. If one looks at experiences in other countries, when investors have lost confidence in the government's ability to manage the budget, they can start selling those securities very rapidly in large volumes and push up rates very fast. And that is a risk for us. That's a risk we talked about at some length in a report a couple of years ago. But we said in that report and still believe that it is very difficult to know whether there is a particular tipping point or what it might be. Because it depends not just on, as I said, the amount of debt of a country, but also on conditions in the international financial system, but also on investors' expectations for policy making in the country in question. I think countries with high levels of debt, where people are confident that debt will be coming down, have much less risk of a fiscal crisis than countries with maybe somewhat lower levels of debt, where people believe that level of debt is rising very rapidly. So expectations about policy, and as I said, confidence in the ability of a government to manage policy are especially important, and that is those are hard things for economists to try to quantify in some way. Yes?
Congress is coming back for a brief sprint of a session in September. You see this recession on the horizon. What should Congress do?
As you know, we don't make recommendations. That's very important. Our responsibility to the Congress is to offer them our best assessment of what will happen under current law and our assessment of what might happen under alternative policies that Congress is considering. They need to make the choices themselves. We talked in this report and have talked in a number of reports about different choices that the Congress has. In this report, we look at the current law baseline and at a particular set of alternative policies, this alternative scenario. But of course, that's not an either-or choice for Congress. There's an entire spectrum of choices that they have. People who have worried about the the short-term economic consequences of this very sharp fiscal tightening have, in some cases, proposed extending some of the expiring policies. In other cases, proposed letting certain policies expire as written into current law, but enacting other policies that would either cut taxes or raise spending in a way that would lead to more purchases of goods and services, and then more hiring by businesses. We did a long report last fall, echoing report we'd done the year before that, laying out a collection of fiscal policy options, doing our best to assess the bang for the buck of those alternative options in terms of how much stronger the economy would be for every dollar of wider budget deficit. And of course, there are other criteria that can matter in those choices as well. So we've offered to the Congress, I think, I hope, a clear sense of the different possibilities, but the choices, of course, will have to be up to them.
For the economy, would acting sooner rather than later be better?
Yes. We think that economic growth right now is being held back by the anticipation of this fiscal tightening, both in terms of the possibility of a sharp downturn, but also just uncertainty about what will happen. So it's both the expectation of a weak economy with all this fiscal tightening and uncertainty about what might turn up. And the sooner that uncertainty is resolved, and especially if it is resolved in the direction of less fiscal tightening next year, then the stronger we think the economy would be in the second half of this year as well as next year. We'd said in May that we thought that economic growth in the second half of this year was being held down by about half a percentage point at an annual rate from this expectation of fiscal tightening. That remains our view. I think that's consistent with the views of outside forecasters. Very hard to know for sure. There's lots of factors affecting the economy. Yes?
Tom Curry with NBC News. Your revenue number, your revenue estimate for fiscal year 2012 is, if I'm doing the math right, it's $133 billion less than the government collected 5 years ago in fiscal year 2007. Can you relate that to this chart that you have and your discussion of long-term unemployment, these extraordinary numbers where you have historically high levels of people being unemployed for 27 weeks or more? Do you assume in your forecast that this becomes kind of the new normal with these extraordinary high levels of long-term unemployment, and how does that affect revenue?
We show a picture on page 31 of the report of long-term unemployment, which is extraordinarily high in this country. We do not expect long-term unemployment to remain at that high level indefinitely, but we do think that unemployment will remain higher than it otherwise would have been because of the lingering effects of this recession and weak recovery. People who lose jobs sometimes find jobs again fairly quickly, but sometimes not. And when they don't, that tends to have longer-term consequences for their lives, of course, and for their employability. People lose skills or don't keep up with advancing technologies and processes. And sometimes employers believe the people who've been out of work for a while might not be as good, and whether they are or not, that can affect employers' decisions on hiring them. So we expect the unemployment rate, even by the end of this decade, to be a little higher than it would have been in the absence of this recession and the slow recovery. That does hold down output and incomes and thus tax revenue. I should say, in addition to the lingering loss of labor input in the economy, there will be less physical capital because investment's been very low in the recession and recovery. It's rising rapidly. Business fixed investment is rising rapidly at this point, but it fell to a quite low level. So we think there'll be less capital for workers to work with at the end of the decade. And we think that productivity will be a little lower than it otherwise would have been. So there's a box in Chapter 2 of the report that talks about the effects, the lasting effects of the recent recession and ensuing economic weakness on potential output. And in that report, we say we think that the level of output at the end of the decade will be about 1.5% lower than it would otherwise have been. That corresponds to a reduction in revenue of about 1.5%. There are other things, of course, that affected our forecast. The recession, as I said, and the slow recovery matter for our future economic capacity. But that is not the principal factor leading to wide deficits under current policies. If we had economic growth that was a lot stronger over the next decade, we would still end up with very large deficits by the end of the decade under current policies. Laurie.
Laurie McGivern with the Washington Post. I just wanted to clarify the magnitude of the 2013 fiscal tightening if we did indeed go over the cliff. So would it be, since 1969, it's the largest reduction in spending or the largest reduction in deficit?
Largest reduction in the deficit as a share of GDP in any single year since 1969.
In 1969 would have been Vietnam drawdown? What was that?
That sounds good. I don't know. I'm sorry to say.
What was the percentage in 69?
Was the deficit between 2012 and 2013 will fall by, I think, 3.3 or 3.4%? 3.3% of GDP. I think the reduction in 1969 was just slightly larger than that, but I'm not confident.
So this would be bigger than any intentional round of deficit reduction of the past 30, since we started trying to reduce the deficit 30 years ago.
Yes, I mean bigger than any. Well, I'm not sure what's intentional and what isn't, but it would be the biggest one-year reduction in the deficit as a share of GDP in more than 40 years.
Robert Pierre, New York Times. Of the assumptions in the alternative fiscal scenario, can you give any indication of which ones have the greatest or the least impact on economic growth?
We have not tried to break down the pieces of fiscal tightening and their individual economic effects. Most of the narrowing of the deficit between 2012 and 2013 comes from increases in tax revenues. Much smaller share comes from reductions in spending. So just by the amount of dollars being moved, the increases in taxes probably have a larger economic effect than the reductions in spending. But that doesn't mean they have a larger effect dollar for dollar. The effects of specific sorts of policies on the economy depend on those policies. That's why when we do these analyses of alternative ways to stimulate output and jobs, we have different estimates for different specific policies. So I don't know dollar for dollar. But over the next 10 years as a whole, the alternative fiscal scenario has deficits that are much larger, as I've said, than under the baseline. About 4/5 of those extra deficits are through changes in tax policy, and 1/5 changes on the spending side.
Dave Lutter with Reuters. Just getting back to the takeaway for Congress here, would you say that this raises the stakes for them to act to deal with the fiscal cliff?
Well, I think the stakes of fiscal policy are very high right now. I've thought that for a while, and I don't know anybody who disagrees, really. We have very serious budget challenges and very serious economic challenges in this country. And the decisions that Congress makes about tax and spending policies can have profound effects on both the budget path and our near-term and longer-term economic outcomes. So I think the stakes are very high in the fiscal policy decisions that we are going to have to make very shortly.
Can you talk at all about, have you seen any change in the large entitlement programs trajectory or costs or revenue since your last one of these?
Yeah, so we have in this projection marked down our forecast for Medicare spending. Medicare spending has come in lower than we expected this year, and that's been true now for several years running. Over the past 3 years, we have marked down our projection of Medicare spending for 2019 by about $100 billion for technical reasons. When we talk about revisions to our projections, we divide them into those attributable to legislation, those attributable to changes in the economic forecast, and those attributable to program-specific factors. And for these program-specific factors, we've now marked down Medicare spending by a fair bit in a collection of revisions. The slower growth of Medicare spending that we've seen is consistent with slower growth of healthcare costs more generally in the economy. In our projections from March for the cost of the coverage provisions of the Affordable Care Act, we noted that private health insurance premiums had been growing more slowly than they had been before, and more slowly than we had expected. And that was one factor that caused us to mark down a little bit our projection of the cost of the subsidies to be provided through insurance exchanges. We have this past year also seen slightly slower growth in Medicaid as well. In the federal health programs and the health system more generally is not entirely clear to us or other analysts. Presumably, the weak state of the economy is a factor, but given the magnitude of the slowdown in national health spending and the timing of that slowdown, which seems to have started before the recession, we and most analysts think there are probably structural factors at work as well. And the sorts of structural factors that are probably happening include slower growth of spending on prescription drugs, There are some patent expirations and fewer new blockbuster drugs. Probably part of it is restructuring the way health care is delivered. What's causing that is also not completely clear. That could be partly due to providers' concern about current or anticipated payment rates. It could be due to changes in the way providers are getting paid in Medicare and also by private insurers. It could be due to more households paying more out of their own pockets in deductibles or cost sharing when they're getting healthcare services. There are a lot of possibilities. Obviously, if you talk to people in the healthcare system, they understand the imperative of their finding ways to do their work more efficiently. But how to connect up that set of activities going on with specific changes in the numbers is very hard. And we don't know to what extent the slowdown we've seen in the federal health programs or in national health spending in the last several years will persist or not. Other questions? Yes.
Getting back to that figure before, so your revenue in fiscal year 2007 was greater, 133 billion greater than the revenue for fiscal year 12. Since the end of World War II, has there been a period, a 5-year period like that, where you have this revenues not recovering where they had been? And does that spell cause you to change the way you look at forecasts for the next 10 years?
So revenues have been a smaller share of GDP during the past few years than they've been at any point in many decades. I don't know exactly how far back that comparison goes. Much of that reduction in revenues relative to GDP is a natural consequence of the weakness of the economy. When incomes fall, taxes fall more than proportionally because we have a progressive tax code, and people who slip down into lower tax brackets pay a smaller fraction of their income in taxes. Another big piece of what has happened in revenue is the policies that have been enacted. For example, this 2% reduction, 2 percentage point reduction in the payroll tax rate under Social Security has cost the government money. Part of what is going on is has been a great weakness of corporate profits, especially in the financial sector, but not just in the financial sector. But beyond all that, we are a little surprised by how weak tax revenues are. And we don't know, again, exactly what's going on there. The detailed tax return data that we and other analysts use to parse out the factors leading to certain levels of revenue come out with some lag. So although we can see in almost real time the total amount of revenue being collected, we don't have the data we need to try to figure out more precisely why. And one factor in this projection is expectation by us that the unexpected low part of tax receipts fades over time. The tax receipts come back up toward their normal relationship with the economy, conditioned on the actual tax policies that will be in effect. And if we're wrong about that, if there's been some more permanent shift, then tax revenue could remain lower than we think. One particular issue that we talk about in this report, and have in a number of reports now, is the labor share of national income. And there is a picture in Chapter 2 on page 43, shows labor income as a share of gross domestic income, which is roughly equal to gross domestic product, except there are measurement challenges. You can see here is a gradual downward trend in labor income as a share of gross domestic income, but one that has been quite sharp in this downturn. And we anticipate that labor income will come back a little bit as a share of total income. Given the weakness of the labor market, the very large number of people out of work, it is not too surprising that wage growth has been restrained, and thus the labor income has been low, but it is lower than we would have expected. And we anticipate that it will rebound to something closer to the average of the past few decades. That might turn out to be incorrect. But we, in general, in these projections, we try hard to have our projections be in the middle of the range of possible outcomes. So for all the numbers here, we think there are significant risks of the actual budget or economy performing worse or better than we've written down. Yes.
Kind of a growth question too. The recent OMB mid-session review said the potential for more rapid recovery is possible due to low levels of resource utilization. Just before you were talking about pages 40 and 41, you have a box on the lasting effects of the recession. They seem to disagree with that. Could you explain why?
I haven't read what they've written, and so I can't speak exactly to that. We talk in our report about one of the upside risks to our economic forecast being stronger housing investment than we've written down. Although, as I said, there are an unusually large number of vacant homes. We also have had a very low level of construction for the past several years. We have extremely low mortgage interest rates. It is not at all impossible that home building will come back more strongly than we think. That may be something that fits in that category. We mentioned another upside risk being a stronger rebound of business confidence and thus business investment and hiring. Businesses are sitting on a lot of liquid assets, cash, people say, and if they felt more optimistic about the future economic path and chose to do more investment in hiring, that could also jumpstart a favorable feedback loop in which the additional investment in hiring would lead to more income and thus more spending by households, and thus, in turn, further business investment in hiring. So we think those are two risks one might think of as being related to an economy that's currently underperforming and the possibility of it performing more strongly. But I don't know beyond that just what they've said.
Yeah, just wanted to get back to the difference between your outlook for next year, why it's gotten worse. Should we go over the fiscal cliff? How much of it is due to the fiscal cliff being deeper or steeper than you thought, with these other programs that have been added on that will expire, and how much of it is just the general worsening of the external economy?
Relative to our projection in January in the budget and economic outlook, the fiscal cliff is now steeper because Congress enacted an extension of the payroll tax reduction to the end of calendar year 2012 and an extension of emergency unemployment benefits to the end of calendar year 2012. That kept the deficit larger in 2012 and going into 2013. It keeps the economy stronger, but by boosting the economy in 2012 without boosting the economy in 2013, it's led to a larger fall off. So that's an important reason why we are looking for a more negative effect, for more negative outcomes for the economy next year than we had expected in January. But it's also true that since that January forecast, we have lowered by a little bit our expectation, our assessment of the underlying growth of the economy. And I have not tried to parse those out exactly. Both factors are at work here. But the magnitude of the slowdown in economic activity that we're discussing for next year is significant. With this very sharp tightening of fiscal policy, we're looking, as I said, to start at a reduction in GDP at an annual rate of about 3% in the first half of next year. That would represent a significant recession. We're looking, under those conditions, the unemployment rate to rise to just over 9% by the end of next year. And the contrast with the alternative fiscal scenario, I think, is quite stark. Under the alternative fiscal scenario, we don't have that kind of recession. The unemployment rate is about 8% by the end of next year. And under that alternative scenario, the total level of employment, the total number of jobs, would be about 2 million larger by the end of next year than it will be under current law. Now,
Sorry, can you repeat that?
Yes.
So you're saying that we would...
Under the alternative fiscal scenario, where there's 2 million more jobs by the end of next year than we would have under current law, according to our forecast. And So this difference in macroeconomic outcomes for next year is very stark. But at the same time, the difference in budget outcomes and macroeconomic outcomes beyond the next few years is very stark as well. The alternative scenario runs up debt by about $1 trillion a year over the next decade on an unsustainable path that will do harm to the economy by the end of the decade. So in both the near term, the next few years, and later in the decade, the current law baseline and the alternative fiscal scenario policies have very different effects on the budget and the economy.
Can you drill down on that, though? How do you get to 2 million if the unemployment rate under the alternative would stay around 8%, but then under the current baseline pop to 9%? How do you get to 2 million jobs?
So the difference in our projection of the unemployment rate is 1.1%. The labor force is about 150 million people, 155 million people. So 1.1% of 155 million is still not quite 2 million. Another factor, though, which is that when the economy is stronger, more people come into the labor force, and when the economy is weaker, more people stay out of the labor force. So one thing that happens under the alternative fiscal scenario is that the stronger economy draws more people into the labor force than would be true under our current law baseline projection. So those extra people are employed. Actually, that factor tends to hold up the unemployment rate a little bit higher. And I think those pieces together add up to nearly 2 million.
Nancy from the Congressional Journal. You were talking about the question of just sort of how and when we deal with the deficit. And apart from just sort of the bond markets, when will this become a problem, just a bigger problem with the economy and with the financial markets in terms of deficit reduction? Is it 5 years from now? How long can we put off these decisions?
Well, we don't know how long this can go on for. The large deficits have a number of negative consequences for the economy. One is that they tend to reduce saving and investment. A second is that they lead to larger interest payments for any given level of interest rates, and that makes it even harder then to achieve certain budget outcomes. A third consequence is that larger deficits and accumulating debt reduce the room for maneuver on the part of the government. People sometimes talk about fiscal capacity, the ability of a country to run up debt if it needs to. As I said when I started, the debt represented about 35% of GDP before this recession. It now represents twice as large a share. If debt stays at the current 73% of GDP or rises further, and then our country were to encounter some further need due to domestic problems or international problems to spend more and borrow more, we would have less capacity to do that. And additionally, as we've discussed earlier, a larger debt means a larger risk of a fiscal crisis, all else equal. But when any of those factors will end up binding in some way that forces action is not clear. I think what is clear from international experience is that waiting to make decisions until action is forced turns out badly. That having to address a large imbalance between spending and taxes at a point when a country really can't borrow anymore ends up requiring very drastic changes that people don't have time to plan for or adjust to. So I think there is no doubt that earlier policy action is better than later policy action. How quickly one implements a set of policies is more complicated because the faster policies are implemented to reduce deficits, the less time people have to plan and adjust. And under current economic conditions, the greater risk of knocking a slowly growing economy off track. On the other hand, waiting longer to implement policy changes allows more debt to accumulate. So there's a real trade-off, a difficult trade-off in how quickly one implements policies to reduce deficits. But agreeing on what the policy changes will be is better to happen sooner. there other questions?
And this is your last one of these until the January, February next year?
Yes, that's right. We release the new outlooks for the economy and the budget in January of each year.
So it'll be either surveying the wreckage or maybe...
We anticipate a very interesting end of the year here, yes. Okay. Well, thank you all very much for coming. Bye-bye.
Yeah, exactly.
Just a reminder, we'll show you the news conference again this evening at 8.